What's up guys, Carboss here, back in another video where we talk cards, money, investing. Today is a special video and I believe this topic has never been discussed on YouTube before, and that's the common accounting mistakes that some of you guys are potentially making in your sports card business. Stick around if you want to know more. Okay, welcome back guys. So as some of you guys probably know, right, so I was previously a full-time accountant, an actual CPA, so I know a thing or two about accounting. So when it comes to sports cards, I believe a lot of you guys out there, especially those who are doing reselling business, whether or not you're an individual reseller like myself or a store, you have your own accounting methods, and some of you may or may not actually use an actual CPA to do your accounting. Okay, now most of the time, right, the general feedback that I get from people is they take the ins and the outs. Pretty simple, right? How much money, revenue, minus how much expenses, costs, right, purchases, and that will determine profit. Very simple equation. But I'm here to talk a bit more today about why that's not exactly true. Now in the field of accounting, there's lots and lots of topics to talk about, but for today's video, I'm just going to touch on two subject matters. The first one is talking about margins, and this is pretty important. Now, let's take for example, right? So if you guys purchase a card, okay, for let's call it $100, okay, and you think to yourself that, look, I'm going to mark it up by 30%, and so which means from 100 to 130, and when I sell it for 130, I'm going to make a 30% margin, and that could not be far from the accurate answer. So no doubt you're going to make $30 of profit. So we can take 130 minus 100, so you get $30, but gross profit margin is calculated based on the gross turnover, so which means that you got to divide 30 over 130, and the actual margin is only 23% instead of 30%. Now to use that, that's still alright, it's 23%. But when you factor in, if let's say for example you're selling eBay, okay, so some of you are probably just buying out actual inventory, let's say for $100, and you're thinking that, okay, I'm going to mark up by 30% because eBay fees is about 15%, and I'm going to end up making about roughly 15%. Now I'm going to show you an illustration right here. Same example, $100, mark it up by 30%, so which means that you're going to mark it at 130. eBay takes 15% off the top line, which is the top there, which is about $20 off your top, and you're left back with 110. So you're taking $10 instead of the 15 that you originally thought. And if you were doing the math earlier, the simple math by is thinking that you're going to earn 30% minus 15% and you get a 15% margin, that's not correct as well, because $10 over 110 net revenue, which means gross revenue of 130 minus the selling cost of 20, is only about 9% of margin. So you can see, from the accounting perspective, the percentage of margins is actually way different from common layman calculation. Now, why this is important? Because absolute dollar margins or absolute dollar profit is more important than percentage as well. When I look at return on a card, okay, I always look at the percentages as well. Whether or not is it worth investing in a card if the percentages make sense. So if I were to buy a card and the only possible return is only 9%, it's probably not something I want to deal with, right? So I want to deal with something that's 15% or more. But in the first place, if I'm not getting the calculation right to determine what it should be 15%, then I may actually be making a lot of mistakes in my business. So I bet your brain kind of like froze for a second just now with with what I just mentioned a couple of minutes ago. So but let me just illustrate for you what the numbers should actually be. So take for example, right, your goal is to make 15%. You buy a car for $100, same example, and you want to make 15% margin, okay? So how much should you be marking the car if you resell on eBay? So eBay takes 15%. So what the first thing you need to do is you need to take the $100, you need to divide by 0.85, which is 100 minus 15%, okay, 0.85, and then we get you a number of 117. So 117 is basically the net revenue that you should be receiving on your sale to derive $17 of profit. So you'll be thinking, hey, $17 of profit, that's more than 15, right? But don't forget, it's 17 over 117, and that will give you roughly about 15%. And that's the desired margin that you're looking for. But that's not the final selling price, because remember I said that eBay is going to take 15%. So you got to recross that number again, the 117, by another 0.85, and that will give you $138. So to sum it up, right, for you to make 15% margin on a car that you purchase for $100, okay, you have to mark it up by 38%. In this case, to $138 in order to make 15%, which equates to $17 of profit. That's so much different to where I started off earlier, where I did mention that, you know, you're thinking that you're going to buy a car for 100, you're going to mark it up to 30% to 130 minus 15% selling cost, and then net 15. So you can see the difference here from the accounting perspective on the treatment of gross profit margins. Okay, so that one's the easy one, right? So I'm going to talk a bit something more complicated in this video. It's going to be a bit longer than about margins, and that's about inventory. Okay, so I believe a lot of you guys, you know, are taking accounting for inventory, basically just recording everything as purchases, right? Everything as costs. Some of you, you know, who buy in bulks, you know, don't even segregate all your inventory by line item. Some of you diligently do it, like myself, but sometimes, you know, you buy like 100 cards or 1,000 cards. It's not actually easy to do. But for good practice and to be more accurate, it's something that you actually need to endeavor. Okay, so I'm going to talk about bulk buying after this, but let's just talk about specific line items, right? So let's say like myself, taking me as an example, I run a portfolio of roughly about like 40 to 50 cards, so it's easy for me to keep track inventory. Now I do have more than 40-50 cards at one time, because I do have cards coming in and then send PSA for grading, and I turn my cards pretty quickly. But at any one point in time in my hand, I'll be holding to like 40 or 50 slabs, and with a spreadsheet I can able to tell exactly how much each of these costs for each of these slabs are, okay, because it's just 40-50, and that would include the actual value of the purchase price, the shipping cost, if there's any grading fees, and so on and so forth. Okay, and let's say, for example, we're going to cut off to the end of the year. For example, right now we're looking at end of 2024, and I would hold, let's say, these 40 slabs. I would able to tell exactly what I paid for these 40 slabs, and these will be the value of my inventory to carry forward to next year. Okay, but let's take it one more step, right? So for accounting, there's a couple of ways to, I would say, value or measure the value of your inventory. Number one, of course, is cost, which is exactly what I mentioned earlier. Purchase price, shipping fees, taxes, everything, that whatever monies that you put into getting the card in your hand, grading fees, etc. Okay. The second one is what we call net realizable value, or in this case, market value of the card. So if, for example, you purchase a card for $100 and you apply $20 of grading fee, okay, so make it $120. But if, for example, you got a PSA 8, okay, and you know, maybe a PSA 10 for the card will sell like 400, and a PSA 9 will sell at 150, but let's say a PSA 8 will only sell for 80. So what's the value of the inventory that you're holding on hand? Is it 120 or is it 80? Okay, so a lot of people actually make the mistake of just carrying forward the value of the inventory based on what they pay, okay, the cost, in this case 120, and not the value that it actually is 80. Of course, you can flip it the other way around. Okay, if you happen to send for grading and you got all PSA 10s, it's pretty obvious that the value of the inventory has gone up, okay, from the 120 you paid to, let's say, 400. But the key thing here is not about whether or not you're recognizing ups and downs. It's actually to understand that you need to periodically update the value of your inventory to maintain the records on where is it sitting now, okay, what are the prices now. It's a huge endeavor, right? Again, like I said, for a person like myself, managing just a portfolio of 40 or 50 cards, it is still time consuming. Of course, fluctuation of cards, you know, they don't happen every day like stocks and equities, okay? Sometimes they move depending on the events that happen around, where a player is injured, you know, maybe he went to playoffs, maybe he got some MVP and things like that, right? So these are kind of like the events that would trigger the movements of prices, which you then need to monitor the value of your inventory. So what about the guys who are doing bulk, right? You got to do low-end cars that you buy in bulk, like maybe 1,000 cars or 2,000 cars, bulk lots. How are you going to value a GTC? It's not actually time efficient to measure every single value of a car, and I do agree with that. Okay, and for some of you, right, when you actually purchase these lots, I think most of you apply the same formula. Right, so let's say, for example, somebody wanted to sell you a lot for $500, comprising maybe 150 cards. Okay, you scan through the lot and you probably pick out maybe the 10 most expensive cards in the lot, and that will work up to be about, let's say, $400. Okay, and whatever other cards that came together a lot, that's the remaining. Okay, but at least you will cover about 80% of the value of the lot, and technically that's how you should be valuing your inventory. So instead of one card at a time, you could do it by blocks, based on the acquisition period that you acquired. So in my case, when I buy a single card, let's say in January of 2024, that's one line item. But if you purchase a lot in January 2024, that will be just one line that has the top 10 cards, the way that you assess the value of that lot, and the rest will be others. Okay, but bear in mind, normally a person like myself, I'm actually quite conservative when it comes to valuing inventory. So things that I feel that I can't move as easily, I don't normally attribute a value to it, and that's a very conservative stand. If you actually sell any of these, awesome, right? That's profit to your bottom line. But if you don't, it's actually just dead inventory. And most of the times, if you're convinced that it's dead inventory, it is dead inventory. Okay, so it is important that for a lot, I know it's a lot of work to do, but you do need to actually dissect those lots further and attribute values to the top dollar cards within your lots, and basically take the conservative approach and to I wouldn't say devalue, but more like assign a lower value on those other items. So the question that you guys may be asking, why do I need to be concerned of the value of my inventory, right? I know what I have, I know what I paid, I probably keep some books, some records, and say that, okay, for whatever 50 or 100 cards, that I own, I spent, $10,000, throughout the year, and I sold a couple of thousand. So I roughly can tell that the value of my inventory in my hand right now is $8,000. But without dissecting, by line items like what I just mentioned earlier, it's not easy to determine whether or not that statement is true or false, and that's important to determine what you're going to do going forward. Okay, so if you take me for example, okay, I always measure, or I always keep track of the value of my inventory that I hold on hand, because I don't want the value of my inventory to balloon or skyrocket to a level that I don't feel comfortable with. So I always try to turn my cards, whether or not it's I would like to do more sales. I like my customers to ask me, do you have this, do you have that? But sometimes I would forcefully sell my inventory just to bring my inventory levels down to a level I'm comfortable with. Now that level can differ for different guys, right? For me, I have a set number, and what do? Of course, the easiest way to put a number of cards into auction. Okay, of course, the kind of cards that you want to send auction, that's entirely up to you, right? What you think that you want to move, maybe you think it's slow, or sometimes you want to sell a player that's hot. Okay, that's entirely up to you. But for me, maintaining a level of inventory that I'm comfortable with, as well as to forcefully generate additional cash flows so that I could have the ability to buy other things. And that's the strategy that you need to employ. And you can't actually do that without knowing how much inventory that you hold on hand at any particular point in time. And the last point, kind of like to just wrap all this up, okay? So when we talk about profitability of your sports car business, it's quite easy, right? Sales minus expenses equals profit, okay? But I look at sports car from two angles. Number one, there is the cash flow profit, which means that actual cash receipts, which is sales, versus the cash outflow, which is purchases and things like that. Okay, and you would adjust it for the movement of your inventory that you hold, and that's where I mentioned that the value of your inventory is very important. Okay, so example, right? If you were to sell $10,000 of cards this year, okay, but you bought $15,000 of cards this year, okay, and therefore there's a deficit of 5. Does it mean that you lost 5,000 this year? Not exactly, right? Because you would say that that's the difference is basically the value of my inventory on hand. Okay, but again, without knowing the actual value of your inventory, without accounting for the inventory that you're holding, you are unable actually to, I would say, identify for sure, okay, whether or not you're making a profit. Okay, so in that example that I said that your total sales is 10k, total purchase is 15. Okay, if your inventory is not sitting above $5,000 for the year, technically you're making a loss. Okay, it's accounting 101. So, and that's why I always stress that you need to really understand the value of your inventory, and not just the amount that you paid for it, but based on the subsequent measurement that I just mentioned to you, to look at the market values post-grading or post-events players up, down. If I have a couple of Ben Simmons, right, that I spent $100 each and I got multiples of them, today is worth 0. So today, even though it's part of my inventory, but it's kind of like it's a forgotten lost stock. Okay, or certain players that are doing pretty well, like Paolo Banchero, Franz Wagner, okay, which I have previously. I bought it for like $800, okay, and it sat for a long time, and I actually marked it down for a while. I'm thinking that whether or not should I sell it for like $500, but I decided to hold on. He's young, he has a promising career, and this year, at this juncture, he's doing awesome, and his cards are definitely worth more than 500 and definitely worth more than 800 that I paid, and therefore the value of inventory has gone up. So that's pretty much it, right? So it's more of me explaining to you 2 accounting tips on this, and so I'm talking about profit margin as well as inventory. But again, I believe a lot of people out there are not exactly going into this kind of nitty-gritty detail, but in order for you to understand whether or not you are actually making money in this business, it's kind of a couple of important things that you probably need to be aware of. Do comment in this video if you want to know more, or you want to have several questions. I'm always happy to answer any of them. Alright, that's all I got for this one. Do like, subscribe, follow my channel for more information and more videos in the future. Thanks for watching, guys. Till the next one. Card Boss out.